Money. It's a word that resonates with everyone, no matter where you are in the world. It's the fuel of our economy, the lifeblood that keeps everything moving. It's how we buy things, from everyday essentials to luxury items. It's how businesses grow, expand, and innovate. We earn it through hard work, we spend it on our needs and wants, but most importantly, we need to understand it to make the most of it. This brings us to banks, the institutions that play a crucial role in our financial lives. They're like the gatekeepers of money, managing our deposits and providing us with loans. They hold our deposits, give us loans, and keep the economy humming by facilitating transactions and investments. But have you ever wondered how banks really work? What happens behind those secure vault doors? It all boils down to a system called fractional reserve banking, a concept that might sound complex but is fundamental to our financial system. Don't let the fancy name scare you. It's actually pretty straightforward once you wrap your head around it. Fractional reserve banking allows banks to lend out a portion of the deposits they receive, which in turn stimulates economic activity. Get ready, because in this whirlwind tour, we're going to break down fractional reserve banking, explore its impact on the economy, explore why saving isn't enough in today's financial landscape, and reveal the powerful potential of investing. Investing can be a game changer, offering opportunities for growth and financial security. So buckle up and join us as we dive deep into the world of money, banking, and investing. Let's unlock the secrets to making your money work for you. Think of banks as financial intermediaries. They connect savers, that's you and me, with borrowers, businesses, and individuals. When you deposit money in a bank, you're essentially lending it to them. They don't just keep it locked up in a vault. Instead, they use a big chunk of it to make loans. These loans help businesses expand, people buy homes, and the overall economy to grow. But here's the catch: banks don't lend out every single dollar you deposit. This is where fractional reserve banking comes into play. It's a system where banks are required to hold a fraction of deposits as reserves and can lend out the rest. Fractional reserve banking might sound a bit like financial wizardry, but it's more like a carefully calculated juggling act. Here's the deal. Central banks set a reserve requirement, which is the percentage of deposits banks must hold in reserve. This reserve acts as a safety net to ensure banks have enough cash on hand to meet withdrawal demands. The remaining portion of deposits, called excess reserves, is what banks can lend out. This lending process is what injects money into the economy and fuels economic growth. Now, this might seem a bit risky. After all, what happens if everyone wants to withdraw their money at the same time? Don't worry, we'll get to that later. Let's say you deposit $100 into your bank account. Assume the reserve requirement is 10%. This means the bank must hold $10 of your deposit in reserve and can lend out the remaining $90. The borrower who receives the $90 loan will likely deposit it into their own bank account. That bank, in turn, must hold $9, 10% of $90 in reserve, and can lend out the remaining $81. This cycle continues, with each loan creating new deposits and expanding the money supply. Pretty neat, right? The money multiplier: small deposits, big impact. Fractional reserve banking creates a ripple effect, amplifying the impact of each deposit on the money supply. This system allows banks to hold only a fraction of their deposits in reserve, lending out the rest to borrowers. As these loans are deposited back into the banking system, they become new deposits, which can be lent out again, creating a cycle of money creation. The money multiplier, a key concept in economics, measures this amplification effect. It essentially quantifies how much the money supply increases based on the reserves held by banks. This concept is crucial for understanding how monetary policy and banking regulations can influence the overall economy. It tells us how much the money supply expands for every dollar increase in bank reserves. For instance, if banks are required to keep only a small percentage of deposits as reserves, they can lend out a larger portion, thereby increasing the money supply significantly. The formula for the money multiplier is simple: 1 over the reserve requirement. This formula helps economists and policymakers predict the potential impact of changes in reserve requirements on the money supply. In our example, with a 10% reserve requirement, the money multiplier is 1 divided by 0.1, which equals 10. This means that banks can lend out 10 times the amount of their reserves, significantly boosting the money supply. This means that for every $1 increase in bank reserves, the money supply can potentially expand by $10. This expansion is not just a theoretical concept, it has real-world implications for economic growth and stability. It's a powerful mechanism that allows banks to create money and stimulate economic activity. By lending out more money, banks can support businesses, consumers, and governments driving economic development and innovation. However, this system also requires careful regulation to prevent excessive lending and ensure financial stability. Banks as economic engines. Fractional reserve banking plays a pivotal role in driving economic growth. By lending out a portion of deposits, banks channel funds from savers to borrowers, facilitating investment and consumption. Businesses use loans to expand operations, purchase equipment, and hire more workers. Individuals use loans to buy homes, finance education, and cover unexpected expenses. All of this contributes to economic expansion. Moreover, the ability of banks to create money through lending helps to keep interest rates lower than they would be otherwise, making borrowing more affordable for individuals and businesses. The safety net of deposit insurance. Now let's address the elephant in the room, the risk of bank runs. What happens if everyone suddenly wants to withdraw their deposits? To prevent such scenarios, most developed countries have deposit insurance programs. In the United States, the Federal Deposit Insurance Corporation, or FDIC, insures deposits up to $250,000 per depositor per insured bank. This means that even if a bank fails, depositors are protected up to the insured amount. Deposit insurance instills confidence in the banking system, reducing the likelihood of bank runs. Inflation, the silent thief. While fractional reserve banking and deposit insurance provide stability and promote economic growth, there are risks to consider. One such risk is inflation. When the money supply grows faster than the economy can produce goods and services, prices rise, eroding the purchasing power of our savings. If you keep all your money in a savings account, especially in times of high inflation, your money loses value over time. This is where investing comes in. Investing. Putting your money to work. Investing is about putting your money to work so it can grow over time. Instead of just saving your money, you're aiming to beat inflation and build wealth. There are countless ways to invest, from stocks and bonds to real estate and precious metals. The key is to find investments that align with your risk tolerance and financial goals. Investing involves risks, and there are no guaranteed returns. However, historically, investing has outpaced inflation and provided higher returns than traditional savings accounts. Choosing your investment arsenal. The world of investing offers a vast array of options, each with its own risk and reward profile. Stocks represent ownership in publicly traded companies. Investing in stocks can be volatile, but it also offers the potential for high returns over the long term. Bonds are debt securities issued by governments and corporations. They tend to be less risky than stocks and provide a steady stream of income. Real estate investing involves buying, owning, and managing properties. It can be a good hedge against inflation, but it also requires significant capital and comes with its own set of risks. The bottom line is, don't just save, invest. Saving money is a great start, but it's only the first step in securing your financial future. Fractional reserve banking, while complex, plays a crucial role in our economy. It's a system where banks keep a fraction of deposits as reserves and lend out the rest. This system allows banks to lend money, stimulate economic growth, and provide a safe haven for our deposits. It's the backbone of our financial system. However, saving alone isn't enough. While it's important to have a safety net, relying solely on savings can be risky. Inflation can erode the value of our savings over time. What you can buy with $1 today might cost more in the future, reducing your purchasing power. That's why investing is essential. Investing allows your money to grow and work for you, potentially outpacing inflation. By putting our money to work in assets that have the potential to grow, such as stocks, bonds, or real estate, we can build wealth and achieve our financial goals. Remember to consult with a financial advisor to determine the best investment strategy for your individual needs. They can help you navigate the complexities of the market. So, there you have it. The key to financial success is not just saving, but also investing wisely. Fractional reserve banking and the importance of investing in a nutshell. Understanding these concepts can empower you to make better financial decisions. Now go forth and make your money work for you. Start today and watch your financial future flourish. Thanks for watching. Don't forget to like, share, and subscribe. I'll catch you in the next one. Peace.